Okay. Now let's try to understand about cash conversion cycle. So basically cash conversion cycle simply tells us that for how much period our money is stuck. So if we see that our debtors stuck our money because they will be paying us later, our inventory gets our money stuck because inventory is stored and futuristically it will be sold, and when we pay to our creditors we stuck their money. So this is a benefit to us. So here if we see these two line items are getting our money stuck, and our payables we are getting our their money stuck. So the net impact of both of all of three them shows our cash conversion cycle. So if we go above and I show you what was our accounts receivable days. So if we go here and we can see our days sales in accounts receivable or DSO period was 100 days, which means debtors were paying us after 100 days, so that stuck our money. If we see our inventory days, so inventory was stuck for us around 109 days, so that also stuck our money. And finally if we see our accounts payable days here, so we stuck other people's money for 80 days. So on a net impact our receivable days are 100 days, 109 days are inventory days, and we stuck other people's money for 80 days. So on a net basis we are having 129 days as our cash conversion cycle. So our cash is getting stuck for 129 days, and finally we get the money. Now why do we use this cash conversion cycle? This simply shows that how long money is tied up in the business operation, how much time it is stuck in the business operations. If this cycle is lower, it means we are getting faster money and we are having better liquidity. Let's suppose that your cash conversion cycle is 2 days. It means that entirely in your business you get entire cycle done within 2 days, and next 2 days and next 2 days. So this happens very quickly, which means you are having better liquidity with you. This helps in the working capital optimization as well. This helps the management to balance receivables, inventory and payables. So basically the quickly management can decide what kind of items needs to be have there. And finally it identifies if cash is stuck in stock or unpaid customer invoices. If the cash is stuck, let's suppose some companies are having 400 days of inventory, or not inventory, 400 days of cash conversion cycle, it simply means that a lot of money is being stuck there. You can do benchmarking and compare with other industry peers and see what is the efficiency level. And finally some strategic business decisions can be taken, just like credit term with the customers, how to negotiate and so on. And investors also use for this credit analysis. Now how does the real world companies uses it? So Amazon generally have negative cash conversion cycle. Amazon generally have negative cash conversion cycle. So basically Amazon simply says that they need to collect cash from customers immediately, because they collect cash and then in future they are getting suppliers on a delayed payment. So basically they are much better. Why? Because they are getting the cash early, and then after the 20-30 days, 80 days, they need to pay to their suppliers. They keeps very less inventory with them, or generally the inventory belongs to sellers. So Amazon also has the benefit of that. And finally they pay suppliers at a much higher time. Similarly Walmart also have close to zero cash conversion cycle. Why? Because they have high DPO, they pay very late to their suppliers, they have very fast moving inventory. So generally inventory days are in the time frame of 1 to 3 days, very less inventory is being held with them, and finally they get very high cash through that. Apple company also have very low cash conversion cycle. Why? Because they have very less inventory, they don't want to have more mobile phones with them, so that they become obsolete. Quick customers don't buy it on credit, people love iPhones, right? So they go and buy it very quickly. And finally long supplier payment terms are there, they pay longer delay to suppliers, that makes their cash conversion cycle very efficient and effective. And finally other automobile companies just like Ford and GM generally have 60 to 120 days cash conversion cycle. Why? Because inventory sits with them for a very longer time, inventories are there for a very longer time. and customers may take some time to pay because there may be some credit issues or other things as well, and supplier terms are also not favorable generally, or it may be favorable, but their automobile cash conversion cycles are generally 60 to 120 days.